The current quote for Hertz Global Holdings Inc., NASDAQ HTZ, is an absolute head-turner, standing at $6.58 per share as of the market's current intraday movement, showing an explosive plus 35.12% surge on the day. This is not a typo. This colossal spike, pushing the stock up over a third of its value in a single trading session, delivers the immediate insight that what the average investor thought they knew about Hertz is now being violently reshaped by cold, hard numbers. The sheer volume that accompanied this move, already eclipsing the daily average before most of the session is passed, is a clear signal of institutional and retail money rushing in to reprice the company after a period of intense pressure and underperformance. This isn't just a bounce, this is a full-blown repricing event, and it immediately throws the common cautious narrative about this stock into the trash bin. For months, the general expectation around Hertz had been one of cautious pessimism. People hear Hertz and they immediately think of the 2020 bankruptcy filing, the massive write-down on their initial famously overambitious purchase of Tesla stock and other electric vehicles for their fleet, and the continued struggle to optimize their fleet mix and costs in a volatile used car market. The consensus among a significant portion of the market and sell-side analysts has been a hold, or even a sell recommendation, with price targets often hovering near or below the $5 mark. They saw a company still grappling with legacy debt issues, facing intense competition from rivals like Enterprise and Avis, and making expensive missteps with fleet management, all under the shadow of economic uncertainty hitting consumer travel. This was the reality reflected in the stock's pre-market activity and its recent months of lackluster performance, where it had been trading sideways or slowly grinding down, reflecting a show-me mentality from investors who had been burned before. The skepticism was understandable. This is a business that essentially buys depreciating assets to rent out, and when fleet costs spiral out of control, the economics get ugly fast. But here is where the deeper reality dramatically exceeds those low expectations. The catalyst for this massive move is the company's third quarter 2025 earnings report, and the figures are simply undeniable. Hertz delivered its first positive diluted earnings per share in 2 years, reporting 42 cents per share or an adjusted EPS of 12 cents, absolutely crushing the consensus estimate that had called for a loss of a few cents per share. Furthermore, revenue came in at a strong $2.5 billion, also beating forecasts. The market isn't just cheering the beat, it's recognizing that the back-to-basics strategy implemented by CEO Gil West, focusing on operational discipline, fleet optimization, and rigorous cost control, is actually starting to pay dividends, and not in some theoretical distant future, but right now. The company pointed to a surge in adjusted corporate EBITDA to $190 million, a nearly $350 million year-over-year improvement. More critically, they achieved a utilization rate of over 84%, the highest since 2018. This number, utilization, is the absolute heart of the rental car business model. It means their cars are on the road, generating money more often, which is the key to profitability for any rental car business. The most compelling aspect of this turnaround is the quiet, methodical execution behind their buy right, hold right, sell right fleet strategy. The market's expectation was that fleet depreciation would continue to be a massive drag, particularly after the EV saga. However, Hertz is reporting that their depreciation per unit per month came in at a manageable $273, hitting their guidance and moving toward their long-term target of sub-$300. They've aggressively moved to sell vehicles through their direct-to-consumer Hertz car sales platform, increasing the percentage of fleet sold via retail channels by a stunning 570 basis points year over year. This retail channel shift is hugely important. Instead of dumping cars on the wholesale market and taking a hit, they are capturing more of the vehicle's residual value by selling directly to the public, essentially becoming a used car retailer as well. This diversified approach to vehicle monetization is a structural improvement to their business model that fundamentally challenges the old narrative of Hertz as a purely cyclical, airport-dependent car rental investment. When we look at the trading action over the past few weeks leading into this report, it was a classic setup for a massive earnings surprise. The daily stock swings were moderate, but the general trend was downward, indicating that traders and many individual brokerage account holders were positioning for a miss or a soft report. The high level of short interest in the stock also meant that any positive news would trigger a violent short squeeze, a dynamic that is clearly playing out today with the stock's astronomical jump. The sheer volume of today's volume suggests a rapid unwinding of those bearish positions, combined with new institutional buyers establishing positions based on the dramatically improved financial metrics. The move is so powerful that it has already blown past technical resistance levels that had been in place for months, transforming the chart from bearish to explosively bullish in a single session. This sudden revaluation is precisely what differentiates a struggling company from a potentially successful turnaround story. The market is now pricing in execution rather than just potential. It's worth reflecting briefly on the core business of Hertz Global Holdings. Through its well-known brands, Holtz, Dollar, and Thrifty, the company is a dominant player in the global rental car space. Their business model hinges on three pillars: the Americas Rental Car, RAC, International Rental Car, RAC, and the Hertz Car Sales platform. Their success, as we've seen, relies on a delicate balance, maximizing utilization, getting cars rented, optimizing pricing, revenue per unit, RPU, and controlling fleet costs, DPU. The company had historically struggled with all three, leading to the dramatic events of the past few years. However, the current momentum suggests they are finally gaining control of those levers. For anyone using an intelligent portfolio or an online investment platform to manage their assets, this case highlights why deep investment research looking past the headlines is crucial. If you had just looked at the negative consensus, you would have missed this massive move. Similarly, platforms like Fidelity, Robinhood, SoFi Invest, or Interactive Brokers give individuals the tools for self-investing, but the analysis must go beyond surface-level sentiment. Shifting focus to the future, the outlook for Hertz hinges on their ability to sustain this operational discipline and manage macroeconomic headwinds. The expectation now, following this earnings report, has drastically shifted from "will they survive" to "can they return to sustainable profitability?" The company is talking about targeting a 3 to 6% adjusted corporate EBITDA margin in 2026, which is a major leap toward their aspirational goal of $1 billion in EBITDA by 2027. This future success will be driven by their ability to leverage their new foundation. They are strategically positioning themselves beyond just being a rental car company. The CEO has explicitly spoken about building a diversified mobility platform that includes the fleet, service, and car sales segments to capture new revenue streams. The sale-leaseback transactions for real estate mentioned in their filings also point to smart financial engineering aimed at freeing up capital for core business activities and managing long-term fixed costs. This is the kind of savvy financial management that can stabilize a turnaround. There are, of course, risks. The global travel market, while recovering, is sensitive to geopolitical events, recessions, and fuel price volatility. The used car market, which they are now relying on for vehicle monetization through Hertz Car Sales, could soften, pushing DPU back up and squeezing margins. The company's ongoing efforts to streamline operations and enhance the customer experience, like those offered by competitors who focus heavily on digital user interfaces and simplicity, must continue. They need to ensure that the user experience through their mobile app and online channels remains seamless to compete with the sheer simplicity of trading on the Robinhood app or managing an account with Fidelity mobile app. The competition from smaller players and alternative mobility options, including ride-sharing, is always present. Hertz has to execute flawlessly on its fleet procurement, and given the complex global supply chain issues for new vehicles, this is a non-trivial challenge. The contrast between the old market expectations and the new reality is clear. The expectation was cyclical struggle. The new reality is operational execution driving structural improvement. The market is now factoring in a company that has not only survived, but is starting to implement a playbook for genuine, sustained profitability. This story should force every investor to re-examine their long-held biases about post-bankruptcy companies. The potential for further upside exists if they can consistently hit or exceed their DPU and utilization targets, while the risk lies in any slip-up that suggests the Q3 beat was a one-off event. It is a stock that requires active monitoring, but today's price action shows what happens when a company finally starts delivering on its promises. This kind of volatility is exactly why investors who prefer lower-risk strategies often lean toward services like Schwab Intelligent Portfolios or diversified Fidelity ETFs and Fidelity mutual funds. But for those with a higher risk tolerance and an eye for deep value in a turnaround, Hertz stock presents an incredibly compelling case today. Looking at the long-term charts, the stock has a lot of room to run just to get back to prior highs, but that's a conversation for another quarter. For now, the narrative is all about this monumental